BODCO. BODCO is the next question that we want to deal with. You've seen the financial data has been provided, but you can take a few seconds to look at it. We have the turnover, the gross profit, and that's the profit and loss side. The profit is 4,900 with cost of sales given as well. Then the statement of financial position has been provided as well, from the non-current asset to the current asset, inventory, and trade receivables. The current liabilities, trade payables, and overdraft provided. The equity provided, and the long-term liabilities also provided. Now let's go into the requirement. Yeah, there are 4 requirements in these questions. There are 2 on upper part, then there are 2 on the lower part. The 2 on the upper part is asking us to explain the meaning of that term, cash operating cycle, and discuss the relationship between the cycle and the level of investment in working capital. Your answer should include a discussion of relevant working capital policy and the nature of business operations. 6 marks. Let's stay on that question. When you look at that question, you realize that there is a lot of things that are being asked for there. The first one is to explain the meaning of the term cash operating cycle, number 1. Number 2 is to discuss the relationship between the cash operating cycle and the level of investment in working capital. Now, in addition to those 2, they are now telling us that we must ensure that that answer includes discussion on relevant working capital policy and the nature of business operations. So that's part A of the question. Then part B now wants us to calculate the cash operating cycle of BODCO. Yeah, and we have to ignore the factors offer in this part of the question. So without the factor offer, you already know what the factor offer will be. Factor agent will be requesting to support you in order to reduce your account receivable days. As you know, one of the ways to reduce your account receivable balance is to get a factor. And if you're able to reduce your account receivable balance, invariably what you are doing is you are reducing your account receivable days. So we won't touch the factor part. That is the second part of the question, C and D. But now I want us to deal with cash operating cycle for A and for B. The cash operating cycle is the length of time. So cash operating cycle is the length of time in days from when the company acquires raw materials to when the company receives cash from the sales to customers. It's not enough to stop there. It's always important to give the formula, which a cash operating cycle is given as account receivable days plus inventory days minus account payable days. And it's also good to just put that last line to say, the shorter the cash operating cycle, the better. In exam, please don't use short COC the way I'm putting in an AR. It's better to write everything in full. Okay, so that's the first part of the definition, which is first part of the question. The second part of the question, I'll say, discuss the relationship between cash operating cycle and the level of investment in working capital. And your answer have to include the working capital policies and nature of business operation. So these type of questions, the best way to go about it is to address it in steps. Look at it. They ask us to discuss the relationship between the cycle and the level of investment in working capital. So we are talking about cycle versus working capital items. So the first thing to say is the higher the amount in inventory and account receivable, the longer the working capital cycle. However, the higher account payable balance, the shorter the working capital cycle. This question asks us to include the discussion around the relevant working capital policy and the nature of business operations. So, which means we need to talk about how the nature of business affect the level of working capital. So we need to say something about that. And how are they impacted? The nature of business has significant impact on the level of working capital balances. For instance, manufacturing industries will have higher inventory balance than service industry. Likewise, the level of risk appetite influences the working capital policy of a company. Now, I'm trying to take care of that part where the question says your answer should include a discussion of relevant working capital policy and nature of business. The nature of the business, I've dealt with it. Now I'm dealing with the working capital cycle. So I'm saying that the risk appetite influences the working capital policy of a company. And why am I saying that? Because there are two types of policy. We have aggressive and conservative policy. And we have to say something about it. We can't stop there. If a company has high risk appetite, it will adopt aggressive policy and thereby have low level of working capital. The company will only keep minimal level of current assets required to settle immediate obligations, and which might not necessarily be enough. Whereas a less, or let me say, whereas a company with low risk appetite will adopt a conservative policy, keeping more than enough, because this guy wants to be safe. So keep more than enough current assets to cover immediate obligations. And with that, you can earn all the marks you need to earn for part A of the question. Now, the B part wants us to calculate the cash operating cycle for BODCO. So we need to calculate the cash operating cycle, and we already discussed the formula. We said this is the formula to calculate cash operating cycle. So we need to calculate the account receivable days. We need to calculate the inventory days first, and we need to calculate AP days. We need to calculate all of that. So account receivable days is calculated as AR balance divided by credit sales multiplied by 365 days. So if I go into that financial data, what's our AR balance? I can check. It's 3,500 divided by sales. Sales is 21,300 multiplied by 365. So I have 60 days as AR days. Inventory days, we know the formula for inventory days is inventory balance divided by credit purchases or cost of sales, either way. Or you can, if you have cost of sales, you use cost of sales. Then multiply by 365. Here we don't have credit purchases, but we are given cost of sales. And we know inventory balance to be 4,500 divided by cost of sales of 16,400 multiplied by 365. We have 100 days. Then AP days is similar to inventory days. The only difference is that now it's going to be dealing with AP days. So AP balance is 3,000 divided by 16,400 multiplied by 365. Account receivable days plus inventory days minus
account payable days.
Account payable days. So we have 93.4 days, and that is the B part of the question. Now, let's look at the second part of the question, which is on factoring. This is a bit tricky, and usually I know students don't even like factoring, but if you follow my approach on how I'm going to solve the question, you're going to like it. It's going to be simple. And the way I'm going to deal with it here is look at this question. The requirement says you have to calculate the value of the factors offer. Number one, on with recourse basis, and number two, on non-recourse basis. We know the difference between with recourse and without recourse. With recourse means that if the receivable is not collected, the factor can return the receivable back to the company. So which means the company will still have some exposure to bad debt because anything that has not been received will be returned. However, that is not the case for non-recourse. For non-recourse, if the factor agent is not able to collect the account receivable, he cannot return the account receivable back to the company. He has to deal with the bad debt. So which means the company is totally free from bad debt on non-recourse basis. And the D part of the question now asks us to comment on the financial acceptability of the factors offer. That's one. Number two, discuss the possible benefits to BODCO. Look at this. A factor has been offered to manage trade receivable of BODCO in a servicing and factor financing agreement. The factor expects to reduce the average receivable days period of BODCO from its current level to 35 days. Yeah, and from the calculation that we did, the current level is 60 days. So currently we are doing 60 days, and if we get a factor, the factor has promised us to reduce it to 35 days. And obviously for him to do that, what he's trying to do is to reduce the account receivable balance. So which means we're going to have a revised account receivable balance, which we will come back to based on those new days. And also, it will reduce the bad debt from 0.9% to 0.6% of turnover. And it will also save BODCO 40,000 per year in administration cost. So these are the benefits that the factor has promised us. And remember, this bad debt reduction will only be applicable to recourse basis because for non-recourse basis, it will be going from 0.9% to 0% because there won't be any bad debt for non-recourse basis. So take note, they don't have to spell all that to you clearly like that. So you need to know from your understanding of the concept. The factor will also make an advance to BODCO. Advance is cash. Please take note of 80% of the revised book value of trade receivable. So remember, every time you have trade receivable, you have to finance it. And like I always said in my previous lectures, your finance cost is just the overdraft rate times your account receivable balance, because your assumption is always that the fact that you have account receivable does not mean that you will not run your business. Your operations have to continue. So in that case, if your customers have not paid you, then you have to take overdraft to keep running your operations until you collect cash from your customers. So that's why every time you have account receivable, you have a financing cost. But this time around, instead of going to the bank to finance your account receivable 100%, the way you used to do it, if you're going to get a factor, the guy is saying as part of our agreement, you will get 80% from me. Then the balance of 20% of your new receivables you can get from the bank. However, I will be the one to give you 80%. And I'll be giving you this 80% at an interest rate that is 2% higher than the 7% that Bootco currently pays on its overdraft. So the factor will charge a fee of 0.75% of turnover on a with recourse basis, or a fee of 1.25% of turnover on a non-recourse basis. Anytime you are being asked to do this kind of question, this factored question, the value of any offer, whether it's even factor or not, value of any offer is about the benefit you are getting from it. So for us to know the benefit we are getting from it, we need to know the cost that we're incurring, and the benefit and the net condition is what we are getting, right? And for us to also be very clear as to whether it's worth it or not worth it, we need to be able to compare with the current situation, because which is what D is talking about, financial acceptability of the offer. The offer will be acceptable if it is making our life better. But if it is not making us better, then it shouldn't be acceptable. So which means that we need three situations. The first situation we should be talking about is the current situation. So we're going to have a current situation. Please pay attention to this approach. It's very important. It will make your life to be very easy. So current situation with recourse and non-recourse. So those are the three situations we're going to have now. Where we are now, if we do with recourse, what does it mean in terms of financial? Non-recourse, what will it mean? And your focus will always be on your account receivable cost. Currently, what's our total account receivable cost? If we do with recourse, what will it be? If we do without recourse, what will it be? The value is how each of these has made us better from our current situation. What are those account receivable costs? Now, because we are getting a factor involved, then we're going to have a factor cost as well, which is the factor fee. Okay. So current situation, what's our admin cost? They didn't give all the admin cost, but they told us that there will be savings of 40,000 per year in admin cost. So which means you can assume, either you assume 0 here, and you have savings of 40 here. But rather, I would tell you that if there is a savings in 40,000, why don't you just put the 40,000 as the current situation? So you know that for admin cost, current situation is 40,000, but once you get these guys, it will be saved and to become 0, 0. Thank you. Bad debt. What is the current bad debt? So the current bad debt, the question has said that if you get this guy, is going to reduce our bad debt from 0.9% to 0.6%, which means currently we are doing 0.9% of turnover. And that will be equals to 0.9% multiplied by the turnover. The bad debt is 0.9% of 21.3 million, and that is it. So that is the current bad debt. And that will reduce to 0.6% if we get this guy to work for us. And under the non-recourse, it will be what? Anytime you get a factor on a non-recourse, your bad debt is 0. For financing cost is tied to the current receivable balance, and in the question, the receivable will be financed with an overdraft that is charged at 7% by the bank. So receivable is currently 3,500 here, and at 7%, so 7% multiplied by 3.5 million. So the financing fee is just strictly 7% of the account receivable balance, and we have it. We have the bad debt. We have the admin cost. Because we don't have a factor yet, so it's 0. Now, let's do the financing cost. The question says the factor will be making 80% advance of the revised receivable. So the interest rates will be charged at 9%, as we discussed, for that 80%, and the balance of 20% will be charged at the 7%, which is the bank. Yeah. So which means, first of all, we need to know our revised account receivable. So with the factor revised account receivable, using that formula will be equals to account receivable days multiplied by credit sales divided by 365. Just rearranging that formula, that's what we've done, and put that into place. The guy said it will reduce our receivable to 35 days. Yeah, and our sales will not change. So that will be 35 days multiplied by the credit sales divided by 365. And that will give us the total revised account receivable of this 2 million thereabout. So which means if we decide to employ these guys, they will be working based on the new account receivable balance, because that is the target that they have given us that they will deliver. So that is what they will deliver to us. They will deliver account receivable of 2 million from the 3.5 million that we used to have, because before them, our receivable used to be 3.5. But once we employ them, we will have receivable to be 2.4. And this 2.2 million would not be financed by the bank, because as part of the factors contract, he has said that he will be the one to finance 80% of that figure. And he'll be financing it at 2% higher than what the bank was offering, and that will be 9%. So the remaining 20% will now be financed by the bank. So which means we're going to have 2 batches of financing. The first batch is the 80% that will be financed by the factor. So 80% of the revised account receivable balance, and that will be financed at 9%. That's the first part. Then the second part is a balance of 20% of our receivable balance that we still have to speak to the bank to finance it at the regular 7%. So that would be our finance cost with recourse. Without recourse as well, it's going to be the same thing, because whether it's recourse or without recourse, it doesn't make any difference. Where you always find a difference is the factor fee and the bad debt. And the factor fee with recourse will be 0.75% of turnover, and that will be equals to 0.75 multiplied by turnover of 21.3 million, 0.75%. And without recourse, it will be 1.25%. So these are the costs that we will incur on our account receivable based on our current situation, if we get a factor with recourse and if we get a factor without recourse. And total cost has been calculated below. The question is, what are the value? So values. If you go to the question, C1 said on with recourse basis. So for C1, which is on recourse basis, that will be equals to, what are we going to save? Currently, we are spending 476,000. But if we get a factor with recourse, we'll be spending 463. And that will be the value. And for C2, the value will be, currently we are spending 476, but if we get a factor without recourse, we're going to be spending 441. And that will be our benefit. And that is what C is all about. 7 marks. That is the value with recourse and without recourse. Okay. The last part of the question wants you to comment on the financial acceptability of the factors offers and discuss the possible benefits of factoring its receivable. So there are 2 in 1 in section D. Are these 2 options acceptable? There are 2 options there, option 1, option 2. Are they acceptable? That is first in acceptability. So we're going to say it this way. The 2 options are acceptable because they make savings for both co. However, the offer without recourse gives more benefit. Therefore, or let's say more savings of about 35,000. Therefore, both co should employ a factor on a non-recourse basis. You will see here, what I've said here is that both options are good because they are both positives. They are both savings. However, 35 is a lot more better than 13. So in terms of financial acceptability, they are both acceptable, but non-recourse is even more acceptable. That's what I have summarized in this sentence. But that will not earn us 5 marks because we need to talk about the benefit of factoring. So which is the last part of this question, benefits of factoring. What would both co-benefit from factoring? So the number 4 that I'm going to take is the fact that both co's management can focus on strategic issues. I mean, which makes sense because they've now given out the operational work of collecting, chasing debtors and all of that to someone to go and do it for them. That has been outsourced. They can spend their energy on things that pertains to their reason of existence as a company, strategic things, how they want to move the company forward, and not asking about whether someone has paid and looking for someone who has not paid them money. And that is everything to earn the 20 marks on board co. And I think this is clear. And if you have any question, you can bring it up.